For some, releasing equity in their home sounds like a daunting prospect, but that's generally because of their lack of financial education, and of course because we're all told from such an early age to pay down our mortgage. It's our greatest asset, right? Wrong. This is not our greatest asset. It's dead money. It's money that could be working for you by making you money, not sitting locked away in your home waiting for you to die so your kids can use it. By releasing equity in our home, we can actually build something measurable for our kids. We're still going to pay the mortgage off, remember, but this way, by releasing the equity, we have the opportunity to purchase cash-generating assets with that money. So if you're considering remortgaging your property to release its equity so you can put it to good use, then you'll need to know how to calculate this to see if it's a viable option. And that's where we come in. So before I begin, I need to point out the obvious. I am not a financial advisor, and this is not financial advice. You should seek professional advice and carry out thorough due diligence before you act. That said, I can tell you exactly what it is that you need to do in order to work out whether equity release is something that you should consider. So my name is David Tan, we're Wise Owl Property Training, and this is how to calculate equity release. Right, we need information from various sources if we're to calculate this properly. Number one, we need to speak with our current mortgage advisor. Number two, we need to speak with a local estate agent and check out some information online, principally Zoopla. And three, we need to speak with a mortgage broker. Okay, so firstly, we need some answers regarding our current mortgage. Number one, how much do we currently owe, including our original mortgage application fees? Number two, is there an early redemption charge? Now, the reason we need to know this is that, say if there are £1,000 or £2,000 in early redemption charges, but we're releasing hundreds of thousands of pounds, then it may be surmountable. Conversely, if we're releasing £40,000 to £50,000 and there is a £5,000 early redemption charge, then we might take a different approach here. So number three, and this is with the previous point in mind, when does your current fixed rate end? Because if that's in 3 or 4 years' time and our early redemption charge is only, say, £2,000, then we might look at using this money now despite that charge. Conversely, if it ends in 3 to 4 months, then again, we might wait to save that charge. Number four, so now this naturally leads us to what is the full redemption figure if we were to redeem the mortgage today. Now this will change by the time we press the trigger with this, but it will be minimal, and having this figure now is crucial to our forward calculations. 5, what is your current mortgage rate? This is more from comparison than anything else, but just like everything else we teach at Wise Owl, it's better to have all of the information and not need it than it is the opposite. And finally, number 6, what are your current mortgage payments? This will be used to calculate the deficit between the old and the new payments to see how much our equity release needs to make us to at least break even, which obviously isn't the point, by the way, but at least this would give us a starting point that we'd be able to make a decision based on this information. Okay, so now we need information from an estate agent and quite possibly Zoopla. We need to contact our local estate agent for an estimate, and we need to corroborate this by heading across to Zoopla's website, adding in our postcode, selecting our property and checking their current valuation, taking note of the confidence rating underneath this valuation. Side note on this, Zoopla's high confidence is very, very good and can be used widely across your property searches and valuations. The minimum rating is okay and the low confidence should be taken with a bowl of salt. Essentially, we need to know how much our property is worth in today's market. Simply, we need to get our house valued. Now, the final bunch of questions are for your mortgage broker, and if anyone is looking for help with this, drop us an email or a Facebook message and we can put you in touch with an excellent broker who will be able to assist. So, number one, what is your current mortgage eligibility? Now, this will generally be based on your earnings. What is the maximum loan you'd be able to obtain from a lender? Now, the word maximum might scare you a little, but remember, we can mitigate fear through education. But also, remember, we might not necessarily leverage the full amount here. Again, though, it's better to have all the information at this point. Number two, what's the best mortgage rate available to you and what's the length of the fixed term of that mortgage? The latter is more important when looking to lock in favourable mortgage rates. Finally, number three, what would your new mortgage payments be based on the higher loan amount from the property? So how do we use all the information we've just obtained? Well, just like our information gathering process, we need to do this in various stages. Firstly, we need to calculate how much equity you can release by taking the full redemption figure from your current mortgage away from the new loan amount. So let's say that the redemption figure from your current mortgage was £240,000 and the new loan amount was £370,000 based on a 90% loan to value and our property being valued at around £410,000. This means that the equity release in this instance would be £130,000. Next, we calculate the difference in our mortgage payment. So that's taking the old payments on our existing mortgage away from what the new payments would be should we press trigger. So let's assume, and these figures are semi-made up by the way, that our existing monthly mortgage payments are around £540, but the new payments would be £1,200. We simply take away the £540 from the £1,200. This leaves us with a deficit of £660 of increased mortgage payments each month. Now, hold that thought before you run for the hills. The third thing we need to do is to calculate what we'd be able to achieve with this equity release in terms of purchase and therefore subsequent cash flow. So a very basic example would be this. We have around £130,000 to spend. We'd be able to buy conservatively 2 or 3 single-let properties and an up-and-running HMO. These would give us a gross monthly cash flow of around £1,800. From that figure, we take away the deficit between the 2 mortgage payments. So that's £1,800 in rent minus the £660 deficit, which leaves us with just over £1,100 of profit each month. Or, and this is where it gets very interesting, we simply use the £1,800 rent to pay our full mortgage. Therefore, £1,800 minus our new mortgage payments of £1,200 leaves us with £600 cash flow every single month. Now that's just over £7,000 every year. And congratulations is now in order because you just achieved exactly what you've been working towards for years, and presumably you were still a very long way from achieving, because effectively now you're mortgage free. By releasing the equity in your home and buying cash generating assets, these are now paying your full mortgage down for you, and they're leaving you with a tidy profit to boot. Interesting, right? Okay, so the last thing you need to calculate is the figure that's left, either in full by paying the deficit between the 2 mortgage payments or the entire mortgage for you. Now, if this is measurable enough and you feel it's going to help your journey in the right way, you have all the answers you seek, or at least you have the right information needed to help with this decision. And all that's left for you to do now is to block out all the noise from the outside influence, educate your partner if you have a joint mortgage, and pull the trigger and get this going. Remember to consider this carefully and always seek professional advice before committing. So that's it, guys. No dream selling BS, no hype to make you think you're going to quit your job next week, work a few hours a day and buy a Ferrari. It's just good, solid, and more importantly, honest education. It's now for you to decide where you go from what we've just talked about. Remember, education is paramount to your success, simply because you understand things on a deeper level the more educated you are. If you head over to our website, you can see this video in a full printable blog format, which does include a downloadable tool for helping with the steps and the calculations. You'll also find many other tools and resources, as well as our free and paid for training courses and mentorship details. If you're looking to get good, solid, ethical education, well done, you've just found the right company. Remember to click the subscribe button below and turn on your notifications for more upcoming expertly explained videos. Once again, my name is David Tan, we're Wise Owl Property Training, and that was how to calculate equity release.